Well, welcome back. The March jobs report revealing 431,000 jobs were added to the economy last month. The unemployment rate falling to 3.6%. It was a mixed report. Weaker than expected job creation. Joining me right now is the former Council of Economic Advisors acting chairman. He is the Klein-Heinz Fellow at the Hoover Institute at Stanford University, Tyler Goodspeed. Tyler, good to see you. Thanks very much for being here. How do you assess the jobs market right now?
Good to see you again, Maria. Well, so it was still a pretty strong report on the employment front, but on the inflation front, the thing that really struck me was that if you look at the household survey, even though the labor force increased, a huge fraction of the increase in jobs actually had to come from the pool of unemployed workers. Now, that says to me that even though we're pulling people back into the labor force, we're not pulling them in by nearly enough to meet this unprecedented labor demand. And that's why when you look at the quit rate, when you look at the vacancy rate, and now when you look at the flows into employment, it's just a very tight labor market without a lot of slack. So I think if you were not betting on a 50 basis point rate hike at the Fed's next meeting before this jobs report, you probably ought to be now.
Yeah, I'm looking at the job creation, and there was retail trade up 49,000, leisure and hospitality up 112,000. These are low-paying jobs in some regard, and it basically raises the issue of inflation, just like you just mentioned, whereas even wages up 5.5% year over year is not keeping pace with the 8% rate of inflation, zapping people's disposable income. Is that going to lead to a sharp slowdown? And then, of course, we look at the inversion that we're all talking about, the 2-year yield and the 10-year yield inverting once again this morning. The yields flipping last Thursday for the first time since 2019, and again on Friday, following the release of the jobs report. The yield curve inversion has often indicated an upcoming recession, Tyler. Do you think this is suggesting that a recession is on the horizon?
So I wouldn't read too much into the yield curve at this moment because it's been highly distorted by the asset purchase programs of the Federal Reserve. So that's going to tend to compress the longer end of the yield curve. Nonetheless, I think that the direction of change in the yield curve is certainly telling us something, and in terms of expectations of tightening financial conditions over the next couple of years. And I would just add a note of caution, which was actually an observation of Larry Summers, namely that if you look at the entire post-war economic history of the United States, if you have inflation over 4% and unemployment rate below 4%, there's about a 50% probability of a recession beginning in the next year and about a 75% probability of a recession beginning in the next 2 years. So this is a pretty fine needle that the Fed have to thread here.
Yeah, I mean, at a minimum, we are expecting a pretty sharp slowdown. We'll see if we see that in the earnings period where we're getting first quarter earnings in beginning in about a week and a half. Liz Peek, jump in here.
Good morning, Tyler. Question for you. Some people are talking about the fact that we're in a real wage price spiral now. Do you agree with that? And what odds do you give on the Fed actually accomplishing a so-called soft landing, i.e. bringing down inflation without a recession?
Good to see you again, Liz. So on the wage price front, look, I think we have been in a bit of a race between wages and prices over the past year, and wages have been losing that race, as they did in the 1970s. And that's despite the fact that a lot of companies took hits on margins last year. It wasn't just from rising wages. It was also just from cost pressures throughout their supply chains. And when you look at regional manufacturing surveys, when you look at the National Federation of Independent Business survey, companies are indicating that they are trying to regain some margin this year through increasing prices. In terms of soft landings, the record here for the Fed achieving such a soft landing, especially when you're coming from a place of inflation being at 8%, it's not a very good record.
Well, what about the record of the president in terms of all of his spending? Last week, he unveiled his massive $5.8 trillion budget proposal for 2023. It includes over $813 billion for defense spending. That's up 4%. That doesn't keep up with inflation either. $32 billion to fight crime and $10 billion for election administration. We're not sure what that is. Tyler, you say the Biden administration's economic assumptions are divorced from reality. Tell us about it.
Right. Well, as you noted, Maria, that was basically a 4% cut in defense spending proposed in the president's budget when you have 8% inflation. In terms of the economic assumptions, look, they are so far above consensus on their expectations for GDP, on their forecast for GDP, that is really going to flatter their deficit projections. They are so far behind in terms of where interest rates already are. That again is going to flatter their deficit projections. And then on the inflation front. They have inflation going back to the Fed's target, basically in the fiscal year beginning October 1st of this year, and doing so with the unemployment rate remaining well below 4%. It just doesn't add up. Those are really, as I said, laughable assumptions.
Well, I mean, Homeland Security, no increase in spending. IRS, a 20% increase in spending, but a decline in defense spending. I mean, how does that jive in this environment where we've got our adversaries rising and investing more in their own military? China now has a larger Navy than we do.
The charitable case I can make is that this budget was finalized probably late last year, November-ish. But I think the more likely is that those are just not priorities of the administration. This is to some extent a political document to signal the economic and policy priorities of the administration.
Yeah.
And evidently these are just not priorities.
Well, we'll see if it matters when the economy has this sharp slowdown that everyone's expecting. Jamie Dimon is out with his annual letter today, and he's talking about unprecedented challenges that the economy is likely going to slow this year. Tyler, what's your expectation for first quarter earnings? We've got the earnings period beginning in about a week and a half with the major banks reporting beginning on April 13th. Do you think we will see that profit slowdown begin in the first quarter?
I think we probably will, but there will be a lot of sectoral variation. It's more likely that we'll see the shift in the second quarter data when that comes out.
Okay. And your expectations for oil at this point? We obviously have elevated prices of gasoline and oil. Is that one of the issues in terms of cutting into growth?
Yes. So every 10% increase, sustained increase in the price of oil, we can expect to shave about 0.2 of a percentage point off real GDP growth. So I think we've had about 40% increase. So you can expect that to shave about 0.8 of a percentage point off real GDP growth. So whatever your expectation was before the oil price shock of the past couple of months, shave about 0.8 off that.
All right, we will leave it there. Tyler, good to speak with you. Thanks very much. Tyler Goodspeed joining us on an economy that seems to be slowing. Thank you, sir.